This legislative summary is brought to you by Main Street Insider. Today we examine the expiring Bush tax cuts of 2001 and 2003. The cuts were passed by congressional Republicans using reconciliation, which helped mitigate the expected impact on the deficit and pass the cuts by avoiding a filibuster, but also required that they be phased out at the end of 2010.
Republicans would make all of those tax breaks permanent at a 10-year cost of $3.7 trillion. Democrats would make most of the tax cuts permanent, except for couples that earn more than $250,000 a year. That costs $3 trillion. And that $700 billion difference is what this fight is about.
The major expiring provisions of the Bush tax cuts are individual income tax rates, capital gains and dividends, the estate tax, the alternative minimum tax, and the expansion of a handful of tax credits. Most Democrats, including the president, believe we cannot afford to extend tax cuts to the wealthy, but support extending cuts for households making less than $250,000 a year.
If you keep tax cuts for the wealthiest, it won't stimulate the economy, but it'll add to the deficit.
Almost all Republicans advocate extending all of the Bush tax cuts and claim that letting them expire would hurt the economy.
The high rates on high-income earners are a disincentive to work.
Now is the wrong time to raise taxes on anybody. We're trying to climb out of this recession.
The Bush tax cuts are currently set to expire at the end of the year, but action to extend some of the cuts is expected during the lame duck session of Congress. For your next summary, tune in Monday to MainStreetInsider.org.